Welcome to the STR Data Lab.
Hello and welcome to the latest episode of the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and today I have two guests. One returning guest, Taylor Jones. Taylor, welcome back.
Thank you, Jamie. Excited to be back.
And then one new guest, John Bianchi, the Airbnb Data Guy. Welcome to the STR Data Lab.
I appreciate you having me here. I've been looking forward to this for a very long time.
Yeah. So we're going to get to quite a few different topics today. Off the bat, I want to disclose I worked with you guys on buying my short-term rental. It was a great experience for me to really just have someone looking over my shoulders, double checking the numbers and helping sort of vet my thesis, and then reviewing properties, going through the underwriting process. And we're going to talk in detail about that. And then secondarily, I just want to talk broadly about the STR investment market and what sort of things you guys provide to people and what you're really seeing out there, since you guys are probably underwriting as many short-term rental investments around the country as probably anyone else around. So you guys game?
Yeah,
Let's
let's
do
do
it.
it.
So let's start with the latter of just broadly what we're seeing in the short-term rental investment market, what you guys are seeing, hearing as you're underwriting deals, and starting with just what STR Search is, sort of how it intersects with TechVestor, and maybe just start talking.
Taylor, if I could just start off with what STR Search is, we'll start there and then we'll hop into what do we see within the market. So STR Search is an Airbnb data consulting firm. We help people understand Airbnb data, and about 99% of that data we're helping them understand is actually AirDNA data. I'm pretty sure I use AirDNA more than anybody else in the entire country, world, it possibly. So this is a very exciting thing for me. Super user without a doubt. But what I've been trying to do is just ensure that nobody buys an unprofitable property, right? That's been my goal since day one. And I build things and services and products and courses all around that. Now, all of my courses and training is free. So, I have helped TechVestor, which is the largest short-term rental investment fund, like STR Search, Taylor and I have helped TechVestor purchase over 150 properties at this point. Every single last one of those properties is cash flow positive. So we have a 100% success rate with our process. That entire process, I created an entire course explaining every single last step that I went through to be able to identify the markets, the properties within those markets, and how to optimize those listings and kind of everything else in between. And I put together as a free course for anyone who wanted it. Because if you want to ensure that nobody buys an unprofitable property ever again, you have to ensure that everybody has access to this information, right? So that's what we did there. And then obviously we have a service where we help you find a property. So the way I always like to explain this is that I'm not a good salesman whatsoever. So the way that I built out my business was like, hey, here's everything. You can do it yourself. But if you want to hire me, you have the option. So then that way it was a really easy conversation for me to have, right? So anyways, yeah, if somebody wanted to hire us, they could hire us and we can find them a property. And that's obviously what we were able to do with you. And we'll definitely get into the details of that. But that's what STR Search is. And that's how we relate to STR or to TechVestor. And then a little bit about what I see within the market right now. It's not easy to find profitable properties. Let's just start off with that. And that definitely has to do with almost all of the home values doubling over the past 3 to 4 years, and then interest rates tripling during that time frame as well. It just kind of killed a lot of the cash flow. With that being said, there's still cash flowing properties that are out there, right? You just have to do a significant amount of more work to be able to find them. And so what I've really, tried to do is just find the markets that have the best opportunity, where there's a ton of cash flow within those markets, where the home values have not shot up in comparison into some other markets where they've like nearly tripled. And if you can find the markets with home values that are still reasonable, but there's still a ton of demand, that's where you find that that crossover where you're going to find that nice cash flow, right? Again, not easy to find, but definitely possible. But then once you find that, you have to do everything to win nowadays, right? You have to, like, it really comes down to design and amenities and bring it together to hit the most optimal demographic. So if you're trying to create a space that is specifically for bachelorette trips, you have to go all out into bachelorette trips and create an experience for them rather than just selling them bedrooms, bathrooms, and a living room, right? And that experience premium is where the cash flow is, in my opinion. So I can get into way more detail on that, but I think that's I'm trying to keep a really high overview on this because I know Taylor's going to want to give his 2 cents as well.
Yeah, certainly. Piggybacking off of that, and Jamie, I think you are accurate. There isn't anybody underwriting more short-term rentals today. We're underwriting across what we believe to be the kind of top 15, top 20, that top echelon of vacation markets where we are seeing cash flowing opportunities. So we're underwriting every new listing that hits the market there on a daily basis. So, hundreds of deals on a daily basis across 3+ years. So we've really seen it all. And to me, from a real estate perspective, we're at historic lows in inventory. And that means there's not a lot of opportunities. And so all of these, what we consider top tier properties, there's just few and far between, maybe compared to past years where more things penciled. I think more deals were presumed to be top performing properties, but they were top performing properties because of cheap debt and cheap cost basis. Now, I think the market's kind of reset. 2023 and 2024, I say, was kind of the great reshuffle and resetting of the deck. And I know people got really used to the highs of 2020, 2021, and two, and it kind of came down. And you've put out some great content. I think people need to take a step back and look at a 10,000 foot view. If you actually just take a boring annualized growth line of the short-term rental market from 2017 to 2018, 2018 to 19, 19 to 20, et cetera, we're actually following right on that trend of that boring 4, 5, 6% annual growth. Now, if you take the volatility of 2021 and 22 in there, it looks terrible and it's coming down. But at a 10,000 foot view, we're still growing and moving forward if we put a linear line on this asset class. And so to me, we're just continuing to do blocking and tackling. And that just comes with understanding the best data. And then, like John said, really making sure we execute. You can't have plain white walls and list a plain 3-2 vinyl siding home and fly over America anymore and make money. So it's really understanding that IBC, we call it our ideal booking client, whether it is bachelorettes, families, dudes, groups of friends, young couples, etc. And you need to design and amenitize to give them an experience that they can't get anywhere else. That experience is your premium, and that's where all the yield is being made in today's environment.
Yeah, so maybe put in perspective, like when you talk about yield, and what one, how do you define yield? And then two, what are the yields that you're seeing today? What do you consider a decent investment that you would suggest someone maybe consider? And how has that changed over the past 3 years since you guys started doing this?
Yeah, well, let's start broadly speaking. The price to rent ratio is the envelope math. So if I'm gonna quickly glance, somebody sends me a deal. Hey, what do you think of this? With two metrics, I can get a rough idea of like, is this worth diving into? And we call this the price to rent ratio, which is in short the revenue made on the property divided by the purchase price, and you get a percentage. The larger that percentage, the more spread you have. The more spread you have, the more cash flow you'll get. With interest rates where they are today, which at the recording of this year, we're probably sitting somewhere between high sixes to high sevens, in the broader marketplace of interest rates. What that means is anything under a 15% price to revenue ratio is going to be hard to pencil. So for example, on $1 million property, you're going to need at least 150,000 in revenue, if not more. 150,000 divided by 1 million gives you 15. Back when rates were lower, you could see deals at a 12, 13% ratio penciling out and still making some cash flow positive. That's not happening today. So, that $1 million property only generating 120 isn't going to be enough to give you a spread because you got debt service, utilities, expenses, et cetera. So that's kind of what we're seeing from an envelope math standpoint. Now, typically, if you're comparing investing in short-term rentals to other asset class, everybody's going to have their own level of, yield, which is just profit that they consider acceptable. So if historical equities is the 8% number, what you'll typically see with people is, hey, they want a premium because this is different of, somewhere at least in the 10 to 12% range. So that's typically where we see most people's kind of bare bones base. However, there is alternatives in this asset class. So you have things like principal pay down, home value appreciation. You have the short-term rental tax loophole, all things that you can't get in the equities market. So these things combined with the cash flow will give you a total return far greater than that. So really you look at this holistically of cash in my pocket plus principal pay down because we are using leverage in real estate, home value appreciation, and then on top of it, if you're taking advantage of the taxes, all of those together could push you up into the 20-30% plus return standpoint if you look at this holistically. Because again, at the end of the day, we all have to pay taxes. We all have other things. So you can't just look at pure cash in your pocket to compare apples to apples. But if you look at this asset class on a total return basis, you're still able to see some 20 to 30% plus where we take into account the cash flow, the principal pay down, the tax savings altogether. So that's kind of what we're seeing in today's landscape and marketplace.
So as you guys talk with clients, as you talk with people sort of entering the industry, what are the big reasons why they're wanting to get into short-term rental investment?
Yeah,
We
we're
have the data on that.
yeah, John, I was
Yeah.
going to say, you want to dive into the data? We are a data company, so let's
Yeah.
dive into the data about what our clients are telling us.
We have a 100% of people are saying they want to take advantage of the taxes. So every single last person, when we're going through it, they want to take advantage of the STR tax loophole or a cost seg or something along those lines. That is always the main reason why they're looking to work with us, and then followed up by cash flow. They're looking for cash flow. So those are the 1 and 2 main reasons why people are getting into it.
Okay. And then when you think about data, you said that, and John, that you probably look at AirDNA data more than anyone. And
Maybe you see it more than I do, but I'm second.
I think it was funny the first time we talked. Like, I got sent a Facebook message that this guy was talking bad about AirDNA data, and I was like, "Could you send me the podcast?" And I like found the podcast and listened to it, and it was John. I'd never heard, and no offense, but I'd never like interacted or heard of you before. But it sounded like you were talking about the data, and very intelligently. But you had this quote where it was like AirDNA, it's a lot of bad data. And then you sort of more nuanced got to like how to tease out the good data. So that was maybe what, 2 years ago. Like, how has your thinking evolved or not evolved when thinking about data and in using it to invest in short-term rentals?
So before I answer that, I just want to be very clear to anyone listening to this. I got in trouble from Jamie. So I was talking about what I would refer to as good and bad data within the, AirDNA, and now I refer to it as good and useless data in the way that I see it. We can definitely get into it, but I got an email from Jamie. He goes, "Can we hop on a call?" And then I got in shit from Jamie. So it was kind of a fun, little moment there after using AirDNA for like 5-6 years or whatever. But regardless, what I was talking about on that podcast, and I have talked about this a lot. So this is like the perfect podcast to make it very clear, what I was saying and be able to go back and forth with you. But I always say that there's good data in AirDNA and then there's useless data. So data that you can't use to make a good decision, right? And what I refer to as the good data are the people who are full-time hosts, and the AirDNA algorithm has been properly recording their data that entire time, right? So some of like the really quick, easy ones to get rid of is if somebody has less than 20 reviews, they're likely not a full-time host. So then we just kind of remove them. Now, on top of that, if they could have 100 reviews, but if they don't have a review every single month for the past 12 months, then they're probably not a full-time host either, right? And so we remove those part-time hosts just in case the algorithm is assuming that they are that when the host is blocking the day, that it's actually a booking. And so by removing that, we avoid the mistake of using data that's not 100% accurate, right? And then the other side of it is that I like for the data to be tracked for over 250 days at a minimum. So,
Mhm.
and we're going to talk about days available after this. I want to make a change to AirDNA, and I'm going to make a case for it.
Yeah.
But if it has been, days available for over 250 days, then I believe that the annual revenue potential, which is essentially a prediction of how much it's going to make over the full year, is accurate or close enough to being accurate within a certain percentage. And so then therefore, if I'm looking at all of the data and I can see that it has over 20 reviews, it has at least a review every single month of the past 12 months, and it has been days available for over 250 days, I feel really confident that I'm looking at a full-time host and the annual revenue number is most likely accurate or close enough. And then that's the data that I'm going to use, and I'm not going to use anything else because that I need to feel confident about that, right? And so then there and with that data from AirDNA, we have been able to successfully find over 180 properties, 120 of them are live, and every single last one cash flows. So even with all of the data that may be accurate or inaccurate or whatever it may be, there is still real data in there that is useful that you can make actual decisions off of. And I think we're living proof of that, right? So yeah, that's what I was stating.
Yeah, and one, I totally agree with you, and to give credit where credit's due, like, a lot of the additional filters we've added into the site, over the past year have been a direct result of those conversations. So now you can go in when filtering to comps and within their DNA platform and just pick properties with more than 20 reviews and with days available greater than 260 nights over the past year, where it was just never a possibility a year ago.
Absolute game changer, by the way. Like, absolute I feel like I can navigate and look into an area so quickly. Now I'm always teaching people to do that. Every single presentation I do, use these 2 filters, and I feel like it's becoming common knowledge. But yeah,
Yep. The I'll admit the area that we still need to make improvements on is our I would when someone's using Rentalizer to really curate the comps that are being included in to only include comps that sort of meet these sort of thresholds of good data feeding through. And just to share some of the sort of inside politics on that, and it's all solvable, but solvable with work of 250 days is great in most investment markets. Like Gatlinburg Pigeon Forge, you should never use a property less than like 300 or 330 days. Like every property there is essentially there full time. You go to Cape Cod, like it's a 4-month season. Most properties are only available like a small number or even some big international markets. And unfortunately, like we're building for the masses, not for specific markets in terms of our tools. But I sort of share that same sentiment as you do when talking through with our clients, our customers on the podcast of the best thing that you can do. And I feel like you guys do a great job is go through each individual comp that Rentalizer pulls back and evaluate, do you think that that's one, a relevant comp? And two, is the data sort of full enough to give you an accurate view of that property's performance?
100% you should be doing that with Rentalizer, but also every other piece of data that's out there too, right? Because like even if you're going to go into any market and you're going to narrow it down to 20 reviews and everything that we just listed there, you still have to go through every single last one of those properties to feel actually confident that the numbers are accurate. And the way I always explain this to people is that it should tell a story. And an Airbnbs are kind of like cars, right? You pay more for a Ford Raptor truck in comparison to a Honda Civic. And some Airbnbs are Honda Civics and some are Ford Raptors, right? And so then therefore they're going to make more money. You just have to be able to see that, right? And so when you're going through the listings one by one, it should make logical sense why one is making more than the other because it's nicer, it's better, it has better photos, it has more amenities, it's bigger, whatever it is, it has more things, and so then therefore it's worth more. And so I find that the final check here for like the data is to really make sure that the story lines up as you go through this. And sometimes you'll find one that makes no logical sense why it's there. Like it's not a good listing, it's small, but somehow it's competing with everybody else. That I remove as well, even if it passed all the other checks. So yeah, agreed with that.
Yeah, I think the term I hear a lot from John because data and acquisitions go hand in hand. They're yin to yang. And, where I'm the acquisitions, John is the data. And so we've been going back and forth and talking on a weekly, if not daily basis for the last 2.5 years. I joke I might talk to John more than my own wife, but that's a part of the biz from data to acquisition. So to me, one thing I always picked up from John was looking for a pattern in the data. So when I'm underwriting, let's just say 5 beds with pools in Miami, if the data's showing a cluster, a pattern of a lot of these that have pools and some similar traits all between 125 and 150, I like that. if there's an outlier, and let's remove the oceanfront, asterisk, but let's just say it was in that same neighborhood and it's doing 205, that's kind of a flaw because you're like, it doesn't have anything that different. It doesn't tell a crazy story. Like, sure, if it had a pickleball court, nobody else did. And sure, if it had a movie theater, nobody else did. But if it has similarities and that pattern is what we always look for, it also gets real tough when you see scattered. You see 105, 130, 170, and 205, and you're going, well, how the heck is there this much spread? And so finding data patterns is something that's been great because John takes everything at a raw data level from your software, from your tools, and kind of breaks it down into digestible chunks. And, John's learned how I like to digest it because you can take data and build it into whatever you want. Well, if you don't know how to comprehend it or make a decision from it, it's worthless, despite being very valuable in theory. So we've obviously developed really good formulas and systems to be able to digest this, like, hey, teach me like I'm a fifth grader, as you always say. And that's what's been great is John will come in, dissect that data, break it down to the level and structure that me from an acquisition side love. I can take that and go hunting in the marketplace and use that to strategically make the best decision on the best short-term rental to acquire.
Oh, that's great. And so, John, hypothetical question for you. So let's say in 30 minutes, I'm going into a product meeting with our engineers, and we're setting the roadmap for Q4. And let's say John gets his wish of, like, if you could make one change to the AirDNA platform and have it come out in Q4, what would that be?
The map, the Lasso tool on the map. That is the so that is the you have so everyone who doesn't know this, Jamie, you obviously created the Tableau version, right?
Mhm.
And that has the Lasso tool. So essentially, I can go and look at a map, and then I can take a little tool and draw whatever I want, and only look at that specific data. I use that every single day. It is an absolute game changer. It's one of the one reasons I don't use the regular AirDNA right now. Your team, like, so the AirDNA team actually reached out and they're like, "Hey, we're switching everyone off of Tableau. We're moving over to AirDNA." I go, "When the Lasso tool comes out, I'll switch over. Otherwise, this is going nowhere." I'm like, "I'm not moving."
Well, fortunately for you, that's already in progress, and that's probably going to be released in Q3. So we won't even have to wait for Q4 for that one.
Okay. Well, there's one other thing then, and this is where I was talking about the days available. From my understanding, okay, the days available is technically how long AirDNA's algorithm has been tracking that listing, right? Has been recording that calendar. And if they have been recording it for a whole 365 days, it'll just always be 365 days for the most part that it's showing there, right? But if they've only been tracking it for 100 days, then it's going to show that it's, days available for 100 days. The number one most confusing thing that comes up often, and like a lot of people say this, well, go, that's actually how long AirDNA has been tracking it. It's not actually how long the listing has been live. And people go, "Oh, really? I thought this meant that this listing was is only available 100 days out of the full 365 days." And I go, "No, that's it's been alive for only 100 days." And so I always tell people that I say ignore that it says days available and imagine that it says days tracked. It's like how many days AirDNA has been tracking it. So that is my other suggestion, to change that from days available to days tracked, because I feel like that there's a lot of confusion on that one as well.
Yeah, and maybe that could be solved with including like a day it went live on the property card of, like this is the day it was launched, because we do pick up every property sort of the day it gets launched on Airbnb. Like, we've got our acquisition infrastructure to make sure every time a property goes live, we find
Yeah.
it, start collecting data on it, and then and there can be a lag between when we find it and then when the calendar actually opens up. And so that would be like, let's say we find it on July 1st, but the calendar doesn't actually open up until September 1st. Like, it's essentially days available starts on September 1st for us, because that's the first sort of day that that property was available to book, that we could have a available night for.
That makes sense. Here's another one that I thought of, or that I've been wondering about. Obviously, I've got a few. So the other one
And
is
after this, we'll move on to other topics.
okay. The other one is review. So Airbnb listings that are on the platform that have 0 reviews. I think those ones might I feel like you guys made a change recently to that. I can't remember exactly, but
We
those
we
ones
we did. Yep.
you did. Okay, I thought so. Right where they're just not supposed to be in there anymore if they have 0 reviews or something along those lines.
No, it's there we found some error in the data on how we're modeling of properties that essentially were getting blocked for certain reasons in the calendar, that was getting picked up as bookings, and a lot of them essentially had 0 reviews. So, property would show up as a lot of revenue, no reviews, obviously something's wrong there, and that was a fix that rolled out, late last year. Yeah.
Is there any way to just, like, remove any property that has 0 reviews? Like, is
Well,
there any
a bit.
why you wouldn't do that?
Yeah, and one, we allow that with the filters, and then but what we don't like by just excluding that in general is because so many properties are new on Airbnb. So I think one of the
Gotcha.
underappreciated things within the data and within the industry is how many listings new on any given month and how many properties churn out. And there's 2.5% churn per month in US short-term rentals. That is, you annualize that, that's 25% of listings in any given year that are churning out. You've got 30% of listings coming in, and delta of that is 5% growth. So, and every new listing has a significantly higher propensity to get booked. So if you are only tracking listings with more than one review or only reporting it, you would essentially see a massive drop in supply always in the most recent month, which would not be representative of the market when trying to. The first thing I do when looking at a market is go look at the supply chart. Like, how as listings growing in this market? Is this a high growth market, low growth market? And if you and you can go in and play with their DNA and do that filter to properties with only one or more review and see the listing growth fall off a cliff.
So, love that explanation. I think, after this, we're scheduling a time where we can hop onto my YouTube channel, and we're just gonna talk about all of these things for 2 hours.
As the non-data guy, I deal with this a lot. John and the data guys can all go on tangents that will last multiple hours if you let them. And as you've seen today with John and Jamie, they do need their own like YouTube live block 2 hours. And it's great to sit back, get your popcorn, but man, they won't stop. And that's what's great. I get the first hand seat at it. So you guys can welcome to my life.
Yeah,
Yeah.
here before we switch off, I just wanna ask one more thing here because I know we're gonna change subjects. I was told, I don't know if this is a true story or not, but if it is, bravo to you. I was told you were told not to make the Tableau version, but then you made the Tableau version over a weekend. Is that accurate?
It is. And we essentially had 2 clients that essentially were willing to pay a lot of money for our data. If you want to buy raw data from AirDNA, we'll sell it to you. But they're essentially like, we don't want the raw data. We want a tool that can allow us to analyze the data and ask the questions we want of it, and we're willing to pay for that. And if you build it for us, we'll pay. So essentially, pre-sold a couple of those, delivered it to them. They're like, "Let's do it." And my boss at the time, our founder Scott Shafford, and he's rational like any person, is like, if there's money sitting on the table and I can take it or not, like, and that allowed me to sort of bring that to market. And yeah, we've had a lot of success and built the foundation for us to build a lot of these, essentially build our advanced tier into the app, of being able to dig into the raw data and have some more advanced filtering, and really sits behind our coaching tier too. So allows people that really want to dig in deeper, not just sort of get the high level insights, that they have the ability to do that.
Yes. So it is without a doubt the most useful tool in the entire industry. There's nothing that even comes even close to it. AirDNA, the site is great, but like it's a world of a difference to be able to have that tool. And I've been using it for whenever TechFester would have picked it up, which is probably a year and a half or more since now, and absolute game changer. So the fact that you put that together in such a short period of time and is like kudos to you. That's all I'm trying to
Yeah.
say. So thank you. In other words, thank you.
I appreciate it. That was actually a result of Taylor and I recording the first podcast, of him showing me how he was analyzing the data. Like, oh no, like there's a much better way to do it. And I think Techvestor, from the day that Taylor and I recorded the podcast, to it was like 3 days later that we had a signed contract, and you guys were using it. Yeah,
We should talk more often.
yeah. So maybe and I want to get into some stories about working with clients, and about maybe the nuts and bolts of actual underwriting of finding investments, and thought it made make sense to like talk about our experience together, and going through and finding my investment. So before I share my side of the story, maybe I could and ask you guys to share your side of the story on what you heard when we were getting started, what your guys' thoughts were throughout the process, and then and we'll talk about and how it ended up.
Perfect. So I always love this. Every investor can be boiled down to two metrics: budget and preferences, which is in short, how much cash do you have and what do you like, what do you not like? So you can't start with, well, I'm going to go to this market, or this is what I care about, or any of this, because at the end of the day, you have two factors that are going to dictate kind of your game plan and strategy, which is budget and preferences. So any investor, including yourself, comes to us and says, hey, Taylor, hey, John, this is my budget and this is what I like and this is what I don't like. And the preferences list varies per client. Some are very detailed, some are very realistic, some are unrealistic. Hey, I'm looking for oceanfront, $500,000's my budget. It's like, cool, that doesn't exist. And kind of like we talked offline, what's really great in the transition we see with clients, and we even got to see with you personally, is when we get a preferences list from a client and it's kind of all written out, it's just words on a screen, it's thoughts in your head. Until you start looking at physical real estate and underwriting and data, your priorities shift. And so what was really great is we had this great long preferences list of everything you would want to get optimally if you could check every box in a short-term rental. Our job is to ultimately go check as many of those boxes as possible. But at some point, there'll be a couple that might not make the cut. And you have to weigh, is having this more important than that? Is having this over here more important than that over there? And so what was really cool is, we started with the big funnel and then ultimately kind of settled where we did with what was truly important to you and your family with this investment, and how to balance all of those factors together. But that same process that you kind of walked yourself through, which is exactly what every client does, is cool. Let me start up here. And then when I start looking at deals and underwriting and data and start really putting nuts to bolts, I can actually see what's most important to me and what matters in an investment. Because yeah, it's impossible to get everything checked off and stay within budget. So within that budget realm, how many of these preferences, which ones are most important, which ones are going to ultimately drive my investment decision? You can't ever really tell until you get into the nuts and bolts. So it was really fascinating to walk through that journey with you, as we do with any client or any investor coming into the program.
Yeah, and to give my 2 cents here, you, Jamie, were actually the exception to the rule. So you were like, so there's one thing that I realized when I was starting this offer to to everybody else. So we've been exclusive with Techvestor for almost 2 years, and then we were like, we're gonna help anybody, right? Because we no longer were exclusive. And what I realized right at the beginning was, if we have people come in and say, hey, can you find me a cash flowing property in Boise, Idaho? We have to say no, because there's no cash flowing properties in Boise, Idaho. So no matter how much I go through the data, it's just not going to happen, right? And I have reviewed over 300, somewhere like 350 to 400 markets at this point, to try to find what I would consider to be the best of the best. And then we tend to put people, not tend to, we put all of our clients into a variety of those markets, right? Depending on their, once again, their budget and their preference. But Jamie, since you are, who you are, we wanted to be able to help you in any way that we could and kind of prove ourselves to you. And so you came with the preferences of, I want to be in Northeast Georgia, and we're like, we don't know Northeast Georgia. We haven't gone to Northeast Georgia. We know a little bit about the Blue Ridge and the LJ market. We stopped buying there like a year and a half ago, or even further now, or longer now. But it was a fun challenge because we had to go, okay, you have a list of preferences, and we're going into a market we're less familiar with, and we have to figure this out all at the same time. And it was interesting. If I could just talk a little bit about the data process of how that went, because typically what we do is we try to eliminate risk as much as we possibly can through the data, right? So what that means is where are the patterns? Where do we see people going? Where do we see the money going? And it was like night and day, as clear as possible. Go to Helen. Everyone's going to Helen within this area. Like that's where the money is being made. Go to Helen. Then so we go to you and we're like, hey, it's clear that we should go to Helen, and you're like, I don't wanna. Right? Like that's it. You're like, That's not what I'm looking for." And so it was like at that moment, I remember thinking to myself, like, okay, I don't know how we're gonna do this. Like, this is gonna be a bit tricky, like to really figure this out. And so the reason being is because it's not to say that you can't make money outside of Helen. It's just that it's so spread out and it's a different type of pattern that we would then be looking for outside of Helen. Because now it's not location dependent. Now it is property dependent, right? What does the property have? What does it look like? What are the views? What are the style? We had to find something that lowered that risk, right? Where we could see that there's a pattern between these types of homes and this type of amenity and this type of unique feature. And if we can find a property that kind of lines up with these, then we have the confidence that this one's actually going to end up working out. And it took a few properties to get there, but I think we nailed it with one you've got. At least I'm super excited for it for multiple reasons, which we can get into. But that was my
Yeah.
experience.
And maybe I'll just opine a little bit on that decision of I'm wanting or not wanting Helen. It wasn't that I didn't want Helen. It was just that where the properties that were available in Helen within the price point and sort of and size that we were looking at, they were essentially all in one neighborhood in Innsbruck. And in a neighborhood of maybe roughly 160 homes, like 80 of them had been listed on Airbnb in the past year. And it's like, is that and occupancy had come down a whole lot. It looked like a lot of them, like you could point out and maybe 20 or 30 of them that were really underperforming. Some of them I'm doing pretty well, but like of thinking about going and competing in that market where 80 listings could potentially overnight turn to 160 listings, like is pretty freaking scary. And given that each one was on a relatively small lot, and you guys, I practice what you preach on, like needing to amenitize and really differentiate your property. Like it didn't seem like most of the properties that were available and seeing how they're performing, that there was going to be that ability to really make something unique.
So to kind of defend ourselves in a little bit, you know what I mean?
Yeah.
To kind of the reason we recommend it in the first place. So a couple things is that I actually love the competitive markets. Like one market we're in that we buy a ton in is Scottsdale, the Phoenix area. There's 35,000 listings there, right? And I've got no problem going in there and feeling like we're going to be one of the top performers just because we know how to compete. And so when we see that there's 80, potentially 160, my thought is, well, how many people are going to that entire area and how much better can you make that listing in comparison to everyone else and get into that top percentile? Because there were some people that were up there. And then, but you've got to be able to take that risk, right? And that's where we have clients where it's like, as much as we show them, they're just like, I don't feel comfortable taking that risk, which is totally fine. Again, preferences, right? Being half the equation. But then the other side of it is that we were trying to get you one of those big old homes that had a little bit, at least a little bit of land, so we could be competitive, because the size there was definitely going to allow you to stand out. But
Yep.
I
The
totally
size
understand.
and then the water feature too. That was one of those things that put a big sort of wrench in trying to find properties, is knowing long term that having some access to water, maybe not necessarily on a lake, but river, stream, access to fishing, kids playing in the water would be something that could stand the test of time. And that is essentially always in high demand in a market like that. So we did end up finding in a property in proximity, like 10 minutes away from Helen. So still using Helen as the demand driver, but also on 5 acres and having a trout stream on it. So over time, we're able to check all those boxes. And one, you guys sort of focused me in on that Helen was an area that really drove rates. Like people wanted to go to Helen, they're willing to pay to be in and around Helen, was one of those factors that sort of narrowed us in. And then finding a large property nearby, and we're successful in doing it.
No, I love it. And as somebody underwriting and proposing these deals to you from an acquisition standpoint, I think what we narrowed down was how important that water feature was to you. And within Helen, it's really hard outside of buying a condo or townhome to be on the river in Helen proper. And so stepping outside gave us that opportunity. On the flip side, though, and I'm sure you remember, I wanted to see how important mountain views were because we looked at a couple like Mountain Ridge on the top, amazing 100-mile views, but gave up the water. And what Jamie, and family circled back to was, hey, this water feature is really most important. So when I talk about that process of what really stands out in your preferences list, to me, wherever you had it ranked when we first started versus where we finished, I know that water was at the top. And that's the thing is, I always give the ice cream analogy. If you start looking at Rocky Road, mint chocolate chips, sprinkles, all of this, you're going to ultimately settle on what you like after you see a variety. But if you only ever know vanilla, you don't know anything differently. And so I think when you could see that different, what is in town look like for Helen based on your budget and what you wanted? What does Mountain View look like? But once you saw that mint chocolate chip, that 5 acres on the water, it was like, this is what I like. And so that's where we start to hone in and get it. And having 5 acres and a water feature is a blank canvas to come in here and start competing. So would love to dive into kind of the property level details here.
Yeah. So maybe we'll start on just like the type of amenities they can and underwriting the property, like finding comps, because and there weren't really any other homes available within a 2 or 3 mile radius. It was a little bit isolated. So how do you think about, and one, finding comps, and then two, projecting what that property is going to earn, given that it can be difficult to sort of point to, and here's 80 other homes in the neighborhood, and like, I'm pretty confident this is what you're going to earn.
So I'll take this one, unless
Yeah,
naturally.
go for it.
This is kind of what I was alluding to earlier, where I said, you wanted sort of outside Helen, and then we only have certain properties that are outside Helen, and we got to find the patterns within those ones. And, just because the property doesn't have a neighbor that's also an Airbnb and we can see how much it's making, doesn't mean that we can't figure out what the revenue potential is going to be. And so instead, what we have to do are take the properties that are also outside of Helen, right? So yours outside of Helen. Well, what else is outside of Helen? Regardless of where it is outside of Helen, just where is it, right? And so that was sort of the very first step to grab each one of those listings, which was good data, data that we can use, and finding every single last one of them, and then organizing from who is making the most to who's making the least, and then trying to logically understand why the people at the top are making more than the people underneath, right? What did they have? What was different about them? What were they doing with their listing? What sort of features and amenities? And ultimately, I think so. Like there's sort of two levels to this. There is what we call the base, where if you do what you're planning on doing, at a minimum, you should make X, right? And that was really what the comps allowed us to do, because I don't believe there was a single. Your home is going to be completely different than everybody else's home, right? With what you're planning on doing to it. And so you're going to have something completely different than everybody else. And so then therefore, when we looked at all those additional comps, we could kind of see, you weren't one of these massive luxury homes that would have had any sort of view. So you're going to be likely below those ones just because they were luxury, right? And then we find the ones that are more of like the regular style homes. And that's where we find your base. And we go, okay, at a minimum, Jamie is competitive with these ones because he has a similar type of home. He has some sort of land. He's going to be doing certain things to the property. There's no reason why he shouldn't be able to outperform this one. And again, it comes back to that car analogy where you're going to have a nicer vehicle that's going to be worth more and people are going to logically pay more for it, right? So that's what we call like the sort of base comp, and that's how we figured that one out, by going through that process. Now, the other thing to this is that you're adding a pickleball court, right? And you're adding an extreme game room, and you're adding this waterfront feature, and you have 5 acres, and you also have 2 units, and so you have a lot going on with this property that give you all these competitive edges, right? Which is what we were going for. And because nobody else has that, and nobody else is showing us what that could actually do, we genuinely cannot say what the property is going to do, right? And so the way that I like to look at this is saying, if all the other properties at our base are making 100,000 and your property is significantly better than them, then you're logically going to make more money than them. How much more? Is it going to be 20,000, 60,000? We don't know, right? But if you're happy if at the worst case scenario, your property makes 100,000, anything above that is good to go, right? And that's the reason why we have 100% success rate at finding cash flowing properties is because Taylor specifically has always hyper focused on protecting the downside. What is their absolute worst case scenario, and will the property still cash flow at that point? And that's why we've always protected that downside to make sure that the asset was still good regardless. But then you do everything you possibly can to outperform everybody else, and it's been working really well, right? So that's how we comped it. We comped it off of all of those surrounding properties, trying to find, which one would be better, trying to find the most likely ones, figuring out the base, and then knowing we'll likely do better.
Yeah, and what I loved is I did my process separately. So, and then we got to be able to go back and compare what what numbers you guys got too, and what numbers I got
Trade
too.
notes. Trade
Yeah,
notes.
and essentially, with the really universe of AirDNA's data to be able to pull off of, and that I went in with getting that base number. Just like you guys, I didn't do necessarily the range, which I love that you guys had, but with our two separate processes, we essentially got to the exact same base number. That base number I was comfortable with that, and I'd seen all the comps that, and even if we're just a mediocre operator, that we're going to be able to hit that. And that there, and you guys were able to show me that there was the upside where if we really crush it, that and we could really hit it out of the park in terms of investment, but that the downside was mitigated, and that there, and if we sort of hit that baseline figure, that this was going to be a profitable investment.
Yeah, I love that. I love that the number one user and the number two user of AirDNA got the same baseline prediction.
You guys are ridiculous. I can't wait for this YouTube special that's going to come out.
So as you guys now go through this process with other clients, you obviously don't have, I'm guessing, people doing that much diligence on each property. I didn't have the experience you guys have on how much amenities are going to cost, how much expenses are going to be in terms of operating this process. So, how much should I weight the history that you guys have with TechVestor and actually seeing the results? And I hear from people all the time. They're like, "Can you tell me exactly what a pool's going to mean for my ADR?" And it's like, man, that's so hard, almost impossible to do. Or like lawn bowling, like what is the increase of ADR from that? And it's essentially like it's impossible, but there's a lot you get from experience that you get roughly like if you get this amalgamation of amenities or this look and feel that you're going to be able to operate in this range. So how do you guys help people sort of figure that out?
So I want to take this one, Taylor, because this has been like my brain baby, like my idea that I've been kind of like going with for a long time. It's just value stacking. It really is that. I heard a story about this hotel out in Vegas during 2008 when everyone was crashing, and everything was going to crap and no one was going out to Vegas and all these different things. The hotel owner, instead of holding back and cutting expenses, he decided to add more value to his hotel, and he tried to stack more things and make it even better and more desirable and all this stuff during that time period. And that actually allowed him to start getting all of the guests that were still coming to Vegas, right? So, the idea of like, hey, there was 1,000 people coming here before, but now there's only 100, and those 100 people, where are they staying? Well, they're staying at the place that has the most value. And so this idea of stacking value to be able to be so much better than the competitors is the thing that I believe is changing in the Airbnb industry more than anything, right? That's where everything is going next. And you see it paying off big time with people who are actually doing it. With that being said, you got to hyper focus on the demographic. You can't, you're not going to put a jungle gym in a bachelorette home. It doesn't make any logical sense. So you always have to start off with who is my demographic and how do I create the most amazing experience for them, and use color psychology to understand, what do a bachelor. That's why you see homes painted all pink as a bachelorette home. That's why you see bright colors for kids' homes. Like using that level of understanding in the listing also allows for it. And so the logic is just simply if we have more value than all of our other people, and we're good operators, we should logically get booked out over everybody else at a bare minimum because we're providing more. And that strategy has just worked over and over and over again. And where it really is going to be tested is when we hit our next recession, whatever that is, and we see what happens when we do go from 1,000 people traveling into all of our markets to 100 people, and we see if we are still at least being able to break even. That is the main objective of our company with every single person that buys property from us, to ensure that they can make it through the next recession by being one of those properties that still gets booked because they are so valuable, right? In comparison to everybody else. So that's the logic, that's the strategy, that's my little rant on that. And if I could just finish off on that, because I know we're coming close to time, your home, the reason why I was so okay with you getting that property is because of all the competitive advantages that you were going to have, right? So you had the cabin feel, which we knew was going to be important out there. You had a bit of a water feature, and there was an opening to that water feature. So you could walk up to it and you could actually put things in front of that water feature to make it a more interactive feature, right? It wasn't just like that it was down and you could look at it from a distance or something. And then on top of that, you had 2 flat spaces throughout the property. You probably have more, but you had 2, right? And then having 5 acres just gives people seclusion on top of that. And then you had a massive additional second living room that you could do a ton with, such as a game room. And so by hitting all these different things in my head, I go, okay, you have a ton of competitive advantages to be able to do things, whether you can do them all now or you can do them over the next 5 years. You're always going to be competitive with this property because of those reasons. So that's my 2 cents on all that.
And then Taylor, maybe getting your thoughts on the expense side and and actual underwriting and going through the pro forma, getting to the yield, the IRR. Like so many companies, I feel like AirDNA does a great job of getting to top line, but we do a terrible job of one, estimate all-in expense going into a property, and 2, what it's actually going to take to operate that property.
Yeah, I think it's the thing I kind of nag about the most when seeing online from other people, other influencers, gurus, etc., is a lack of good, true underwriting and what it actually takes. These are small businesses, small hospitality businesses. You're not buying real estate, you're buying a operations business that just so happens to have a piece of real estate attached to it. That's how you have to look at this. And when I see, because I've personally been an operator for 4 years in different markets across the US, I've been able to tap into, TechVestor and other operators from networking, and you see patterns. I know realistically, nobody who is a full-time elite operator is running their OPEX ratio below X percent. And I know that it could balloon up to Y percent depending on labor, age of home, size, et cetera. So when I see projected expenses that I know are significantly below or just flat out missing line items, because you truly have to take everything into account: taxes, insurance, pool cleaning, snow removal, trash, utilities, Wi-Fi maintenance, furniture replacement, shampoo, coffee, toilet paper, etc. If you're light, your numbers can look good. That's why I tell people, like, you can underwrite to get a number that you think makes you sleep well tonight, or you can underwrite what the actual expenses are going to be. And then the other thing is taking into account larger CapEx items that are going to hit you. If your roof doesn't break the first year, sure. But at some point, that roof, if it's a 20-year shingle roof and it's, 15 years old, you have to account for that at some point, because at some point you're going to have to fork over 20, 30 grand for that new roof, or HVAC or water heater or electrical panel. So your big 4 CapEx items. So to me, properly accounting for those is what makes it difficult, because if I underwrote to the standards that I see online, there'd be a lot more deals penciling. And I think that's a huge mistake, as people fall trapped to, they see these deals posted online, these deals in newsletters, these deals on Instagram. And when I go re-underwrite these deals, it's no 16, 18 cash on cash. It's a 4 or a 5, because I know what the actual expenses are going to be to operate this as a business. And so one thing we wanted to make sure with you, and we do with any client, is, hey, I'm going to underwrite what I know from 4 years of operational history across 12 states. So we see high labor, low labor, small, big. We've operated homes at 400 square feet and 4,000 square feet, I guess technically 5,200. So I've seen everything in between. And to us, a critical thing with our clients is we're going to operate what's actually going to incur with you, because we don't want you to be surprised when your expenses are 10, 20, 30% higher than expected. And so that's a critical thing, is nailing everything that it does take into account to operate this business, whether you're operating an ice cream shop, a software company, a car dealership, a salon, or an Airbnb. You have to make sure you get your expenses correct, because there is a set of things that will occur when operating the property.
Oh, that's awesome. So we are running short on time. I got one more question for each of you, and then we'll wrap up. But it's maybe opening you guys up to your crystal ball. And we're sitting here in 2024. It's been a wild ride in the industry over the past 4 years, and we saw record industry performance. We now see record high housing values. We see interest rates that seem to be dropping, though who knows that that's going to be sustainable. So where do you see short-term rental investment playing out over the next 2 years? And just to put some numbers behind it, we've got industry growth in the US right now, overall supply growing 5-6%. It's middling, and 2 years ago it was growing 20+%. And pre-COVID it was running 10-15%. So like, where do you guys see things going?
Can I go first, Taylor?
Go for it, John.
Who's the guy who has that investment fund? His name starts with a B. It's like the largest. Berkshire Hathaway. What's the guy's name?
Yeah, Warren Buffett.
Thank you. Warren Buffett has a metric out there that kind of can predict when a market is going to correct itself. And it's essentially, I can't remember exactly what it is, but it's twice as high as it was in 2008. So, and it's the highest it's ever been ever. So I strongly believe that there is going to be a major correction within the next 2 years. And I also I used to be a financial advisor for about 3 years. And I had to study the markets, and there's always a correction no matter what, right? So I strongly believe we're going to have a correction. And I think that correction is going to tighten every single last person's pocket. And then I believe that we are going to see a huge shift in the Airbnb industry, because people will not be able to travel. Then therefore people will not be able to rent, make money off of their Airbnbs. And I think a lot of the people that were talking about the doom and gloom of the Airbnb bust, where they, bought a property, overpaid for it, or paying too much in mortgages, and are like barely making any money from these properties in the first place, when we do hit that recession, they're going to feel it 10 times harder, and it's going to look really bad. It's just kind of a writing on the wall. So I think that there is going to be a correction in the Airbnb industry. That does not mean that it doesn't make sense to buy an Airbnb, because the reality is that as soon as we get past that correction, that's where you have the greatest growth that there is in any industry. The 2009, 10, 11 were amazing for real estate, right? Right after COVID, amazing for real estate. So as long as you can figure out a way to make it through that time period, you're going to be doing amazing with your business, or whatever it may be, with your Airbnbs. But I genuinely, if you're asking me for the truthfully what I believe, I think we're going to hit a recession. I think we're going to have a huge correction. I think everybody's going to hurt for 6 months to a year, and then things will go back to how we want them to go. They'll lower the interest rates. They'll do whatever they got to do to pump the economy, and everything's going to look amazing at the end of the year after that period. So that's my prediction. Probably not what you guys were expecting, but that's genuinely what I believe.
Yeah, so John's the bear. What are you thinking, Taylor?
So I like to look like, where's the puck going, and go skate over there. So I'm looking at things like average booking on the platform, and I think it's 3.6 or 3.8 bedrooms now, and that number has continued to grow quarter over quarter. With Airbnb being public, these quarterly updates are really fascinating, and I'm looking at metrics within those outside of buying the stock that most people are. And when I see things like that, I go, okay, you got to go really big is kind of the direction of where things are going. A lot of the really sophisticated investors are exclusively only buying 4s, 5s, 6s, and 7s right now, because average group size has grown for, I think, 8 or 10 straight quarters on the platform. So what you're seeing is, in a recessionary environment, more people might not be able to afford to just travel with their family. So they're going to tack on more people, so you have more heads to split the bill with. Because at the end of the day, if that place is $1,000 a night, splitting with 10 people is easier than splitting with 5. And so now you could still afford to get those great amenities and that great experience. So on the flip side, I think you got to go small. Where I see a lot of problems is that 2, 3, and 4 in the middle there, per se, because you're kind of in no man's land right now with who you're going after, and you better have it nailed. one bedrooms, you do always run the risk of competing with hotels. And so what I think is having that experience level offering as a one bedroom to couples who want something that's not a hotel that a hotel can't offer. I see those doing really well, during this next, 2 years as well. So to me, you got to invest at the pools. Ones and 4 to 5 plus is really where I see the puck going, especially for the next 2 years in how to win at this asset class and nail it, because the middle doesn't have an identifiable space right now. And that, I think, is the unknown that a recession in the next 2 years might entail. Is who knows what the middle is going to happen. The middle's thrived, and I see cracking right now in the middle. But what I do still see is big groups traveling, big group homes that are high design, high amenitized, kind of the blueprint that you're running in a short sense with yours, as well as the other end of the pole, which is small experiential travel that hotels can't compete with for that traveler. So that's my view: is avoid the middle for the next 24 months, for the foreseeable future.
Awesome. Well, guys, this was very enjoyable. I love chatting. I felt like we could have gone for another hour or two, but time is up. Thank you guys so much for joining.
Thanks, Jamie.
And if people want to find you, find TechVestor, find STR Search, how do they do that?
You can go to strsearch.com is the main website, or you can reach out to Taylor and I. I'm on Instagram mainly, Instagram and YouTube, 2 spots, at the Airbnb Data Guy. And Taylor?
Yeah, I'm over on Twitter, formerly Twitter, now X, and LinkedIn, Taylor Jones or Mr. Jones, STRs. You can find me. So I do the copywriting on the written platforms. John does the video platform. So we do the yin and the yang like we talked about.
Love it. Again, thank you guys, and I'll see you soon.